In this video, we're going to talk a little bit more about interest rates itself and the impact it may have on the value of bonds. So first of all, let's think about interest rates. We know that interest rates change from time to time. So how does that impact the actual value of a bond? Well, we know for the valuation formulas that the interest rate in the economy, the yield to maturity, the discount rate that we use, that can change because the real rate changes, risk in the company changes, and certainly inflation changes. So the value of a bond will change over time. What doesn't typically change is the coupon payment or the maturity date or the principal. Those are all fixed in nature. Now, when a bond matures, it is worth exactly $1,000 because that's when the loan is paid off. So if you think about, if you hold everything else constant, right, the yield to maturity doesn't change over time. When you buy it, it's fixed until it matures. But again, when it matures, it's always going to be worth $1,000. And here you can see several different types of bonds, how their values change up until the 30th year, in this case for the bonds, when they're equal to $1,000. So there's an inverse relationship between interest rates and bond prices. So again, as interest rates rise and as bond yields rise, bond prices fall. Now, what we're interested in discussing here is something called sensitivity, right? How sensitive is the bond's price to changes in interest rates? And we have a statistic for this that's called duration. Bonds that have high durations are very sensitive to interest rate changes. So when interest rates change, bond prices move significantly, either up and or down. So duration is a statistic. It's much like the statistic with respect to beta, where beta measures the change in returns as stock market changes. So what is the mechanism that ultimately influences then the value? And what we're looking at is something called interest rate risk. Interest rate risk is that risk that is the most powerful risk actually for bonds. And there's two parts to interest rate risk. Price risk is the change in price due to changes in interest rates. And we've talked about this a lot. That's the one we typically discuss when we're talking about risk and bonds. Long-term bonds are going to have be much more sensitive to price risk than short-term bonds. So long-term bonds and low coupon bonds have more price risk. Now, price risk is instantaneous. As soon as interest rates change, price risk changes. Reinvestment rate risk is a risk that happens over time, that as interest rates in the economy change, those cash flows that we receive and then reinvest are reinvested at different interest rates. So in this case, if interest rates rise, prices fall. We know that's bad. But as interest rates rise over time, reinvestment rate risk is going to give us higher cash flows in the future. So it's a positive thing. So the exact opposite is true with respect to reinvestment rate risk. Short-term bonds and high coupon rate bonds are much more sensitive to reinvestment rate risk than low coupon bonds. So what does this look like graphically? Well, if you look at the differences in maturity, again, we're looking at the slope of the lines here, you can see that long-term maturity bonds are much more sensitive. They have a steeper slope than short-term bonds. And indeed, if you look at low coupon bonds apparently have a higher slope, a steeper slope than, low coupon bonds to high coupon bonds. So again, this just completes our discussion, if you will, about the influence of interest rate risk on bond prices. So how does this influence, or what does this have to do for the company? So let's say that you want to buy an asset in the future. Let's say in 10 years you want to buy an asset, and this asset's going to cost $1 million. You want to make sure that in 10 years you have exactly $1 million. There's a lot of ways we can invest to get this, but one of the ways is to buy some zero coupon bonds. So if you buy 1,000 zero coupon government bonds that mature in 10 years, in 10 years you would have exactly the amount of money you need, which is $1 million. The challenge with this, though, is that we may have invested more money than we actually needed to. There's an opportunity cost. What if we could buy corporate bonds instead? Corporate bonds are going to pay some dividends. So corporate bonds are going to have reinvestments. They're also going to have the principal value of the bond over time. So maybe we can invest less money in corporate bonds and put that money into other investments. So the question is, how do we make sure, or how do we ensure that we have the right amount of money? And the process, this is what's referred to as immunization. And immunization is the process of equating the duration of assets to the duration of investment. And if we do this, at the end of the time frame, if we immunize over time, we will have exactly $1 million to buy whatever we want, but we'll be able to do that with the least amount of investment as possible. This is what's referred to again as immunization, and it deals with the statistic called duration. So how we measure duration, if you look at the bond evaluation worksheet, there is a segment of that has to do with duration itself. So for this bond, we have $1 billion in debt. It's a 50-year bond, 3.5% coupon, yield to maturity is 4.2%. So what is the value of this debt? And if we plug this in, you'll see that it's worth roughly $854.64. If it's selling for $850, what is its duration? Well, we look at the number we use, we're going to quantify or look at here is the modified duration. In this case, it's 21.55. What does that mean? It really doesn't mean anything. It's a statistical measure. The bigger the number, the greater the sensitivity to risk. So in this case, if interest rates change by 0.1%, what would be the new value? If it goes up by 0.1, we know it's going to go down. When interest rates go up, bond prices go down. So in this case, the value is going to drop by negative 2.16%. So the new price would be $831.68. Now we also can look at an additional statistic called convexity. It's for another class, another day, but it would fine-tune this a little bit more to take care of some curvilinear nature of the bond valuation graph that we saw them earlier. They're curves. So actually with convexity, it's going to be negative 2.12%. So we're off by 0.04% here. So we have a new price, $831.99. So again, what we have is we have a measure of sensitivity, right? The greater the number, the greater the sensitivity. So the next thing we want to talk about are just some basic pricing theorems, right? So if you think about the law of one price, right? Bonds of similar risk and maturity are going to be priced to yield about the same return. Similar risk things should have similar returns. And it really doesn't matter about the coupon rate. They'll have the same returns. How we can use this then is we can use this to predict prices of other bonds and other assets, because we can associate the risk of those assets with the values, the cash flows of other assets. So let's finish this video talking just a little bit about government and corporate bonds. And primarily, we want to concentrate on taxes. Treasury securities, obviously issued by the United States government, right? The general rule is that that you pay taxes to the company that issues the debt, or not the company, to the entity. So if the federal government is issuing treasury securities, if you pay taxes, you're going to have to pay taxes to the federal government. You won't pay taxes to state and locals. So obviously we have T-bills, T-notes, T-bonds, just generally differences in two things. Number one, some of them pay coupons, some of them don't. But in general, the difference is maturity. Now, municipal securities, they're issued by states, local governments, etc. Those entities, since they're issuing the debt, you have to pay taxes to the entity that issued it, which in this case would be state and local governments. Now, the difference between the two then is taxes. The additional difference is risk. So we know that treasury securities, things issued by the United States government, means things are risk-free. The municipal securities are not risk-free, so there is a chance of default, which means that municipal securities initially could have an interest or a yield that's higher than treasury securities. However, they have this added benefit of also being tax exempt. So how do we choose between corporate debt and government debt when we have differences, not necessarily in risk, but if we have differences in taxes? So here we have an example. We have a taxable bond that has a yield of 8% and a municipal bond a yield of 6%. Now there's a saying that says it's not how much money you make that counts, it's how much money you keep that counts. So we need to associate in this relationship, we need to understand in the end, what do we get to keep net of taxes? So if you earn 8% and it's taxable and you're in a 30% tax bracket, that means you'll get to keep 5.6%. So this taxable bond, in the end, net, you'll receive 5.6%. Now, if these are equal risk things, which would you rather have, 5.6% or 6%? And of course, you would rather have the municipal debt rather than the corporate debt, because you get to keep more of your money. Now, can we figure out what tax rate you'd be indifferent between the two? Our formula, basically, you just solve for T. And if you solve for T here, we find out that the tax rate that makes these two bonds indifferent, we don't care which one we buy, is 25%. So if your tax bracket's greater than 25%, you would want to buy the municipal. If it's less than 25%, you would like to buy the corporate bond. So again, the difference, there's differences in risk, there's differences in yield, but in the end, we want to determine, if we assume very similar risk, we want to determine the net after-tax return that an investor gets. So that's it. I look forward to talking to you in the next video.